is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 46 was recorded on January 19th, 2017, on the eve of Donald Trump's inauguration as President of the United States. I'm Erik Townsend. Real Vision founder Raoul Pal gave us a fantastic macro interview back on September 15th, but so much has changed since then after the election of Donald Trump. So Raoul is back as this week's featured interview guest. We're going to go back and revisit all of the macro topics that we covered in the September interview, from the U.S. dollar rally to treasury yields to soft commodities, and see how Raoul's views have evolved since the September interview. Then we're going to look ahead to trading opportunities in 2017. And don't worry, folks, I'm not going to let Raoul off the hook until he tells us what the heck he's got Aaron Chan working on over at Real Vision.
And I'm Patrick Ceresna, joining the program this week as your new producer and co-host. I'll introduce myself in more detail after today's feature interview with Raoul Pal, but right now let's dive straight into the market wrap. Erik, the S&P 500 has tested that 2270 to 2275 level 6 times in the last month, each time failing to bullishly follow through. We're going into the inauguration trading at this 2260 level. What's your feeling on how this plays out?
Well, I think that clearly the sell the inauguration view that so many people have been talking about is about to be tested. And we've seen, clearly a sell-off today on Thursday, just at the open, I think was the high print of the day, 2269.5 on the E-mini S&P futures contract. So the cash index would have just barely touched that 2270 level. And it's selling off, as I would expect, as I described last week. The question is what happens after the inauguration. And, I think there's a lot of people that have made a good case. It's time to sell this. The Trump rally is overdone, and we're headed down from here. I'm not trading it, though. I'm on the sidelines, and the reason is simply that I've been wrong quite a few times here, thinking that this market was overvalued. So I'm not going to risk it. I'm not going to be on the long side, but I'm definitely not going to go short either. Definitely Donald Trump's comments Monday evening to the effect that the dollar is already overvalued and causing problems for U.S. businesses that cannot compete effectively in international markets. That's not helping here either. But, if we come out of this and somehow move to all-time highs above 2280 immediately after the election, that really sends a strong signal. I'm not predicting that, but frankly, this market keeps blowing my mind. One thing I would say could be a significant downside catalyst. I think that the general public is underestimating just how much could go wrong at the inauguration tomorrow. We've got 250,000, 250,000 protesters descending on Washington, D.C. Against 28,000 security forces. So the protesters outnumber law enforcement by about 10 to 1, and some of them have been exposed. Certainly there's a lot of people that are just going to express their protest viewpoint in a peaceful and democratic way, and that's fantastic. But we know for sure there's a lot of people that intend to try to provoke disruption and conduct illegal activities. I think that you could see a really big upset where the market kind of wakes up and says, hey, wait a minute, the bull case here has been that if Donald Trump was successful at doing all the things he's set out to do, that would be good for the market, which it would be. If what we see in the inauguration is a major disruption where, Donald Trump has to be evacuated by helicopter because there's a riot in progress or something like that, I think it could really be a wake-up call for people to recognize just how much division actually exists in the country and how strong the half of the country that opposes Donald Trump feels about their convictions. If some big bad event happened at the inauguration, I think that could definitely be a downside catalyst.
Now, Erik, I need to ask you what's going on with crude oil. We've seen that price test that $55 level twice in the last month and has failed to follow through on last week's push higher. With crude oil currently trading around the 52.17 level on the March contract, how do you think things play out?
Well, I definitely think that 55 is the resistance level for the economic fundamentals before you consider geopolitical event risk. So what we've seen is this rally up to 55. As you say, it's tested it, it can't break through it. And I think the supply-demand fundamentals point to lower prices. Certainly what we saw this week in terms of inventory numbers, analyst expectation consensus was for a drawdown on crude oil inventories of about 1 million barrels. We ended up with a 2.3 million barrel build. There was a drawdown in Cushing, Oklahoma of about 1.3 million barrels, but there was a massive build of 6 million barrels in gasoline inventories against a drawdown in distillates of just under 1 million barrels. So on the whole, we're seeing builds for the most part on average. Obviously, there's some builds, there's some draws, but if you net the numbers out, we're looking at some pretty bearish data here. So what could potentially propel things in the other direction? Again, as I've described in past shows, I think that Donald Trump is going to get tough with ISIS very quickly after taking office. I don't know what that looks like. I don't know what form it takes, but I think that there's a potential that fear of a geopolitical escalation could cause a dramatic upspike from here in oil prices. If that happens, I'm shorting it because I think we're already at the top of the valuation range on a fundamental level.
Now, we've seen the price of that 10-year Treasury bond future squeeze higher over the last month. After the 10-year yields hit a high of around 2.6% in December, we've seen yields drop back down, testing around the 2.3 level. Anything new in your fixed income outlook?
Well, I think that Donald Trump's comments are very much at odds with his own policy, and that's going to have to be resolved. If you look at what's going on with bond yields, if you look at what's going on with the dollar index, Trump says the dollar index is too high already, implying that something needs to be done to get it lower. But at the same time, his policies about forcing large multinationals to repatriate assets into the United States are extremely dollar bullish. And a stronger dollar comes with higher bond yields. So how can Donald Trump say that he's upset with the Federal Reserve for keeping interest rates artificially lower? He thinks rates ought to be allowed to move higher. Well, that's got to be dollar bullish, but he also wants the dollar lower. So the market's got to figure out what his policies are actually going to be because he's spinning rhetoric on both sides of this. So I continue to think that the big question, that probably the most important question of 2017 is going to be, is the 35-year bull market in treasuries over? Are we really beginning a secular bear market? Or is this a stumble, as Raoul Pal has predicted in the past? I'm definitely going to hit him up on that question again in today's interview. And where are we headed from here? I don't really have an answer right now, but I think it's the most important question to pay attention to.
That's very valid. So I want to now move on to looking at gold. And we've seen gold continue to strengthen, hitting a high of around the 1218 level earlier this week before pulling back. It's currently trading around the 1204 level Thursday afternoon. What's your take on what's going on with the yellow metal?
Well, I definitely think that Donald Trump's comments about the dollar being too strong helped get us to that 1218 level. As the dollar index, a lot of people thought, okay, it's all over for the dollar. Turns out we just hit a pretty predictable support level just above 100, and it looks like we're moving back to the upside. We haven't quite broken out of that downsloping channel yet, but I think that we're going to. So the strength in gold that we've seen, I think, was about weakness in the dollar. Now, if Donald Trump makes more comments or makes policy-setting statements that would portend a lower dollar, then that could certainly propel gold higher. But I kind of feel like we've seen this rally play out as far as it can, unless the dollar index rolls over again. So it really has to do with what happens next for the dollar, I think, as far as what happens to gold.
Now, Erik, you've already made numerous comments on that U.S. dollar. Let's just touch back on that subject to wrap things up on the outlooks.
I think the key in my mind is that we are still holding key support. If the dollar index stays above 99 or so, I'm not worried. I doubled down on my long dollar index position when we hit 101. I had a resting limit order to try to add more to that position if we got all the way to 100. Turns out that 100 spot 23 was the low print so far. So I missed that opportunity. But I'm looking at this as Trump says things that are negative for the dollar. It causes a reactionary dip. But in reality, Trump's policies are all extremely dollar bullish. So I think the weakness is a buying opportunity. I wouldn't be at all surprised if this dollar rally, and actually the whole Trumpflation rally and everything, kind of takes a sell the news pause after the inauguration, especially if we get a major, civil unrest upset on Inauguration Day on Friday. But on a technical level, so long as the dollar index stays above 99, I'm not worried. I'm looking at this as a buying opportunity, and I think all of the fundamentals point to a stronger dollar as we move into 2017.
Erik, thanks for that update. Now, Raoul Pal is the founder of Real Vision Television and global macro investor, and he's definitely been one of our most popular guests. Erik's interview with Mr. Pal is coming up as Macro Voices continues, right here at macrovoices.com.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Real Vision founder Raoul Pal is back with us this week, and of course Raoul gave us a fantastic interview back in September. Raoul, before we get started, I'd just like to thank you publicly for being such a perfect gentleman, which is so rare in the finance world. You guys have hired Aaron Chan, our former co-host and producer, and you have just been fantastic about it. You understood that would put me in a bind, and you've allowed Aaron, even when working on your payroll, to continue to host the show until we could get Patrick on board in order to replace him. So I just want to thank you for that.
Hey, thank you. I mean, Aaron's such a great guy, and you gave him such a great opportunity to learn so many things. He's going to be a real asset to us at Real Vision. So, thank you again for all your help in that.
It's my pleasure. I'm very pleased to see that Aaron's involvement with MacroVoices led to a career opportunity for him, and I wish him all the best. He's a super guy. What I'd like to do is borrow from a format you guys use on Real Vision called Rewind, where you have clips of what a guest said last time and kind of compare how the world has changed. Now, I don't have a Real Vision production budget, so I don't have clips, but let's go back to our interview from September 15th. First thing we talked about was the U.S. dollar rally. You said at the time that it was paused but set to resume, you thought. And of course, it has begun to resume, although in the last week or so, it's maybe taken a little bit of a nosedive in reaction to Donald Trump saying that the dollar's too high. So did Trump's comments change your views at all?
No, not necessarily, because what he says and what he does are two different things. And we've known that from the beginning of the Trump campaign. So he might say the dollar is too high, but it's very difficult to not allow the dollar to appreciate if you're doing certain things such as walking back from globalization, putting up tariffs, which generally mean there's less dollars out in circulation. So the amount of dollars available for world trade fall. Therefore, people who need dollars because they're the $10 trillion shortfall that we've talked about before, that the BIS have identified, those guys need to cover their dollar positions because there's not enough dollars and the dollar keeps going up. So the less dollars in circulation, the more problematic it is for the global economy. So on one hand, he's saying, look, we want less of this globalization. We want to make sure that trading is fair amongst nations. We want less of a trade deficit. Now, when you're the world's reserve currency and you have a smaller trade deficit with the rest of the world, it means you're starving the rest of the world of dollars. So it's almost impossible to get what he wants. So he either has to have a weaker dollar or he can have the protectionist measures that he wants for the US domestic economy. So I think, the Trump thing is complicated for the whole of this dollar trade. I think all we've seen now is just a correction as we go. I know a lot of people keep saying to me, no, the dollar's turned. Maybe they're right. But the balance of probabilities and how I look at things is the dollar's still got much further to go, and therefore a dip like this is probably a buying opportunity.
Now, let's suppose that you and I are both proven right, and the dollar does have not just a little bit, but a lot further to go to the upside. And let's suppose we get, say, north of 110. At what point do you think this leads to enough problems that central bankers around the world are forced to contemplate, let's call it Plaza Accord 2.0, where there's some kind of coordinated intervention effort to arrest the dollar from appreciating anymore? Does that come into play anytime soon?
Well, again, it's difficult because we're trying to get a head around what this kind of protectionist trade war is going to look like, what it means, and what tensions it brings. Because at one point, if I look at the parallel example of what happened in the 1930s, when we had a similar situation where the US dollar kept going up in relative terms because it was pinned to gold, eventually everybody else had to do something about it, and they eventually devalued the dollar because all the currencies got smashed, world trade got smashed, et cetera, et cetera. So, I think there's further to go before people get together and try and negotiate something, because in this mercantilist world, we find that people actually want to have weaker currencies over time.
When we spoke in September, Treasury yields, U.S. 10-year Treasury was yielding 1.60. Quite a big difference from where it is today. You predicted at that time, you had actually covered your long bond positions brilliantly, I might add, back in August, and you predicted a rise to at least 2% as being likely. But at the time, you thought that would be a buying opportunity by the dip. Of course, a lot has changed since then. Do you still see it that way? Do you still think we're headed towards sub 1% yields at some point with a recession? Or maybe has the tide changed to the point where we really are seeing the beginning of a secular bear market in bonds, as so many people have suggested?
Yeah, I don't believe that. I do think the US economy is very much following how the Japanese economy went 20 years prior or 10 years prior. And I don't think these reflationary measures are anything more than the market hoping that something's going to change. When you've got the demographic issues that the United States has got, when you've got the massive debt overhang that the United States has got, it's very, very difficult indeed to generate inflation. And so I think the bond market is pricing in some of the reflationary policies of the new administration. But the chances are that many of these things, such as protectionism, such as a stronger dollar, actually lead to weaker growth and lower inflation. So I don't think, again, the market can have what it wants and listen to the narrative that Trump is giving us. So I think, could they get back up further? Quite possibly. Could they get to 2.6, 3%? Possible. I don't think it goes above 3. I don't really think it goes a great deal higher than here or where it was at the recent peak. So I still think bond yields come lower over time. I don't see anything that can change the demographic trend. For us to generate realistic, meaningful inflation over an extended period of time, which is what you would need to change the bond market from being a bull market to a bear market, you would have to see a change in spending patterns and demographics amongst people. And I just don't see that. Even if you bring jobs back because you're penalizing companies from going abroad, yes, you might see some wage inflation. Does that wage inflation go through to end product inflation? Less likely. With so many people trying to retire, an aging population, those things tend not to filter through. And we've also, you've got to imagine that if they start to bring companies back and labor is expensive, then the likelihood of a robotized labor force increases dramatically, and that itself is deflationary. So I don't think this is meaningful. I can be wrong. Soon we'll know. Around these levels, go a bit higher, and something has changed. It's possible. It's not my base case.
And you said that there is, of course, a possibility, as there always is, that we might be wrong. A couple of people, Bill Gross has said 2.60 is the magic line in the sand. Jeff Gundlach said no, 3.00, even 3% is the magic line. Do you think there's a magic line, a number after which you would throw in the towel and say, okay, my view has to change because, the tape is telling me something other than what I expected?
So I'm looking, as we speak, at the 10-year bond yield chart of my Bloomberg, going back from 1985. If you join all the peaks, you get a trend line that would suggest 3%. If you use more recent peaks, which is going back from 2009, we broke some of those. If you use your pencil slightly differently, let me see, as we speak, I can do it real time, we're probably about 3.2. So it's kind of around those levels, and that's all I'm doing is saying, listen, there's a very, very well-established trend. Does that stop the market? Most likely. If it goes beyond that, then most likely something has potentially changed. Now, that doesn't necessarily mean we'll have a bear market forever. What it could mean is we trade sideways. I mean, that's another thing. Markets hate thinking that. They all go from, well, it's going from deflation to hyperinflation. And they haven't really thought the fact that maybe bond yields just trade in a 1 to 3% range over the next 20 years. It's possible.
We also talked back in September about the business cycle. You observed at that point that it was already the third longest business cycle in history. That was as of September. And you predicted that it would eventually lead to a follow-on recession. You also observed that the two-term incumbent president cycle, that is, situations like this where a two-term incumbent president is replaced by the other party, there has been a 100% chance of recession within 12 months after that. Now, back then when we had that conversation, Raoul, most of the smartest guys in the room, whether it be Ray Dalio, Stan Druckenmiller, Carl Icahn, they were all bearish, just like you and I were. But these guys have all turned fantastically bullish in the wake of the Trump presidency. I don't know about you, but I just don't get it. I don't know what magic wand they think that this guy's got. Because I don't think there's ever been a case of a president having more people that, hate his guts and want to kill him than Donald Trump. I don't know how he's going to be successful at all these things. What do you think about all of this bullishness that's out there?
Okay, so you need to separate out what they truly believe is going to happen to the US economy going forwards, or what they think the market is going to perceive to happen and to trade that opportunity. That's what they're very good at. So they may think that deflation, slow growth is baked in the cake, and policy errors, whatever they may think about the Trump administration. But they know that the market wants to interpret it as a reflationary trade, and therefore the trade is reflation until it's not. And that's what these guys are good at, is not sticking to the view, but also putting their view aside and saying, okay, what is the market psychology? Should I trade the market's view, even though it's against my view?
Next subject we discussed was European exit contagion. And I think back then in September, you observed that you thought that even the U.S. election cycle was really part of something bigger, a growing global populist movement. And you thought that that would probably spell a very bad outcome, at least in the long term, for the European Union. Of course, a lot of your views have been confirmed with the election of President Trump. By the time most people hear this, he will be president rather than president-elect. We're speaking on the eve of his inauguration. What do you think now? I mean, is the situation better, worse, or the same from our last conversation in terms of the prognosis for the European Union?
Well, the prognosis is still the same. It is increasingly difficult for European nations to hold things together because of the financial issue. On a social level, people don't want it to change. Europeans have a pretty good quality of life. They have a lot of benefits of being within the European Union in terms of the social contract that they have, which is much more pro the average guy than other countries, the UK and the US. Hence why the UK and the US got the populist movement much larger. But going forwards, it's difficult to know what happens to Europe in this situation. It's not entirely clear that breaking apart from some of the parts of Europe is a good thing. Other bits, such as the currency, would be a very good thing. And I think over time this populism movement does develop, but we need to bear in mind that the market is expecting this. So tail risk is priced reasonably fairly in Europe. People are all looking for the next shoe to drop. They know, they looked at Italy, they looked at, they're looking at France, they're looking at the German election. All of these things people are looking at, and therefore they tend to be less interesting from a market perspective. And if we're going to see something different, it has to come as a wild card. Brexit was a wild card, and that shook things up for a while. The Italian election, which was an important election, the referendum, actually amounted to nothing in the markets.
And we also spoke specifically about the European banking system. You observed that Spanish banks were at all-time lows back in September. Nobody was talking about it except for you, perhaps. We were looking at negative rates still at that time. And, of course, you pointed out that Deutsche Bank's derivatives book was just out of control. So any update in terms of what you see there? Of course, the negative rates have eased off, so maybe that's not going to last. But how do you see the rest of the picture developing?
Some of the Spanish banks still keep falling. Nothing has been resolved there. There's no news flow. There's nothing positive. The increase in bond yields takes the pressure off for a little bit. It's not necessarily negative rates in places like Spain or Italy because they didn't really see them. It's just the insolvency of the banking system overall. The positive yield curve has helped. I think the very flat yield curve was more of a problem, but the steeper yield curve has helped take a little bit of the pressure off. But it's, my question always is how the hell do these guys get through the next recession? In good times, with reasonable economic growth, it's okay. But if you have a recession, then who's going to get wiped out in this? It's almost everybody, so it seems. And that's what I can't get my head around. People ignore that because everyone's so quick to take a snapshot of here and now. You know, the economy's growing at whatever, it's okay, therefore the banks are okay. We have to live in the future as investors, and particularly in the macro world, is, okay, what happens in a recession? What are the dominoes that fall over, and how does that affect everything else?
One of the risk factors that we discussed last time was this crazy VIX contango trade, where basically people are shorting VIX futures because each time they roll that contract forward, they capture the contango by being short, and they see it as a way to produce income. Of course, that's not just picking up nickels in front of a steamroller. That's pennies being pried out from under the steamroller. And so far, a big downdraft in equity prices has not happened, which was the big risk that you saw there. You described how if there was a sudden downward move in equity prices, it could really blow up in these guys' faces. Is that risk still in the system? Is that trade still on, or have people wised up and gotten out of it?
No, that trade still goes on to this day. And, it reminds me a lot of the portfolio insurance stuff around around 1987, or some of the kind of spread trade, low vol trades that happened around 1998. People go over their ski tips with this stuff. They think it's all manageable, and they think that, okay, we can sell VIX, and if we lose money on that, we'll use this as an opportunity to buy stock because we've been taking in premiums. But they don't realize the rate of change of the VIX can be so extraordinary that the losses can mount up massively and super quickly. So, I worry about that position. I worry about a whole world that's set up for low volatility when you've got a new administration that is almost unquantifiable. We don't know what kind of volatility should be under an administration like this, but a relatively aggressive administration should create more volatility overall. So in which case, the generalized level of volatility should rise.
Let's move on to precious metals. We, even in the face of rising inflation expectations, gold hasn't done too well since we spoke in September. And of course, a lot of people think the reason is that Treasury yields are on the rise, and that's the competitor to gold. It seems like the Fed is signaling more rate hikes in 2017, and of course, Mr. Trump is encouraging them not to artificially lower rates the way they have in the past, although I'm not quite sure how. It seems like that's totally at odds with his dollar is too high statements. Where do you see precious metals going from here? What's your outlook?
So I think precious metals just do the inverse of the dollar for the time being, until we get to the point that you kind of alluded to before, where either the central banks have to do something about the strong dollar, or economic weakness comes through, which has not happened yet. Every time it comes, the economies bounce again. But if pervasive economic weakness comes through, then the market will have to forward price more quantitative easing or fiscal stimulus financed by the central banks themselves to come. And if that's the case, then gold rises and the dollar rises. So that was one of the core theses of mine, the gold and dollar. I mean, they've been relative as a trade, as a pair, using a basket of 27 currencies against gold. It's been relatively flat. It was hugely positive for a while. It gave some back. But really, that trade moves in a situation where we get economic weakness and the central banks have to do something, and the chances are the dollar rises and gold rises.
You said that for now you would expect the dollar to rise, and you're expecting gold to move in the opposite direction. So is it time to be in that pairs trade, long the dollar and long gold at the same time, or is it time to wait for maybe a better opportunity to add gold to your existing long dollar position?
Yeah, it depends how you do it. If you put the trade on as a trade, it has to be in reduced size because it's a trade you want to hold on for a few years. So it's not a trading position, it's an investment position. If you want to trade gold now, I'd look for a lower entry point. Whether that entry point gets down towards 1,000 or whether we just retest the recent low at 1125, don't know. Don't have a strong view yet. I'm just kind of watching the price action, watching the chart morph, looking at the economic conditions and waiting for a real opportunity as opposed to just a trade.
Another risk factor that we discussed last time was the whole clearing and custody system, Euroclear in Europe, having as much as 30 times hypothecation of collateral that, is all being passed back and forth in this big fancy electronic system. But at the end of the day, who finally antes up and covers the bill if there's a default? And you described this basically as creating this too big to fail problem for the entire European Union, where if any one sovereign fails and defaults on its treasury obligations, basically the whole European Union blows up at that point. It seems like we've got heightened risk of maybe one of those countries failing at some point. So is there any improvement or any attention being paid to this issue that you described last time?
Well, something at the margin happened that I thought was very interesting, something I've been talking about for maybe 3 or 4 years now, which is the move by the DTCC, so that's the US version of Euroclear, towards using blockchain technology for the custody of and clearing of, I believe it was some derivatives or swap contracts. I'm not entirely sure, can't quite remember. But I have a feeling that the entire system will go onto blockchain technology, which allows you to know who owns what in the event of a bankruptcy. It also allows you to reduce the amount of leverage in the system. Now, it's not easy to do because you'll immediately reduce the amount of leverage in the system, which is a catastrophic event for the system. But over time, I think that's the biggest development. I think it's the biggest single use of blockchain technology or Bitcoin itself is in that custody of financial assets, because these things are cesspools of risk that nobody understands. They are slightly arrogant as organizations because they have a backstop by the central banks if they go wrong because they are too big to fail. But the problem is the mechanism by which they would do that means that they would end up pledging customer collateral to the central banks, which is terrifying. It means that even though you're a safe bond fund with no leverage and you've got your stuff nicely in custody, you suddenly find and you've got your bonds to protect against bad events, and then suddenly you find out that the DTCC or Euroclear has pledged your bonds to their central bank for liquidity injections, and you could lose all of your bonds. So, yeah, I don't like that whole situation. I definitely think it moves towards blockchain, and I think that's going to be a fascinating development.
I couldn't agree more. I think that would be wonderful if we actually saw some progress in blockchain technology being adopted by governments and official institutions. Another subject that we discussed back in September, soft commodities, especially grains. Your recommendation at the time was it looked like maybe there was a buy there, but perhaps hedged by a short on copper, just in case there was a downturn in the economy. Any change in your outlook for soft commodities?
I've been waiting for something to change in soft commodities, and basically there's been no great opportunity yet. But I think it's coming. They tend to be quite cyclical. Most of them have rallied since we last spoke, but we've not had, one of those accelerated moves. And that needs a weather event generally, whether it's, Russian grain harvest or Australian grain harvest or, Argentinian crops. It is set up slightly that because of the La Nina from last year, there is a shortfall in various crops in South America, which had the real issues. There was a potential to see the El Nino. We have a potential for a La Nina event coming this year, but it looks like it's going to be very weak if it comes at all. So I'm watching and waiting. I don't see the great opportunities that I was expecting to see, but they probably trend higher over time anyway.
Raoul, that concludes my list of topics that we discussed last time. I want to move forward now to looking forward towards 2017 and talk about what the opportunities that you see on the horizon are. I don't see a lot of directional trades right here. I'm kind of on the sidelines in the equity market. Where do you see opportunity as we look ahead to 2017?
I'm kind of with you, Eric. I don't see an obvious trade. If we look at the bond market, my bias, which is I think yields come lower, but is here the opportunity? Probably not. So there's nothing I can do there. I don't see a huge backup in yields to make me a fortune if rates go higher. I don't see rates yet falling until we see some economic changes, some economic weakness. Don't really know. We've got a new government that's come in. We don't really know how they're going to act, what they're going to do. So it's very difficult to trade based around that policy and clarity of policy. We have really no idea what the central bank's going to look like in a year's time or so. So it's difficult to trade around that. The only thing I do know, if I look out and say, what's an obvious trade, the dollar still seems to be a pretty obvious trade unless somebody does something to roll back this globalization or even the thought of repatriating profits from companies abroad, which is another strong dollar event. Even if they're in dollars abroad, let's say Apple's profits are in Ireland in US dollars, once you take those out of the markets in the offshore Eurodollar market, that makes the funding conditions even tighter and the dollar goes higher. So the dollar situation seems pretty obvious to me. I don't see anything that would change that. There is no risk yet of the central bank starting to cut rates or looking at doing any excessive policy. So I think that's still the cleanest trade in the world. The trade that's a little more difficult but becoming more interesting to me is having a shot at the short side of the equity market. I use demarked technical indicators. I found they're very helpful for me. We've got a perfect monthly, daily, weekly setup, which is very rare. Usually, at worst, the market goes sideways, or at best, the market goes sideways. At worst, the market has a sharp correction, or it's the entire top. I don't really have a view yet on what that is. I'm just monitoring that, noting with interest that this position is there, noting that the market bought the election, and knowing how fickle markets are, they probably sell the inauguration. So that's one thing that's kind of interesting. Go on, Eric, what do you think?
Well, I'll see if you want to grade me on the thoughts I have. The only real directional trade that I see right here is long the dollar index, and I think we agree on that. We've already discussed the reasons why. Beyond that, the things I'm looking at, if I look at the term structure of crude oil, we've got a fairly steep contango for a few months, but then we see backwardation in the belly of the curve. So apparently we're not going to need storage after June or July or so. It's going to be a non-issue. Those tanks are going to be empty. I'm not buying that story. So I do see a curve steepener trade that is, let's say, I actually just bought a bunch of spreads, short June, long December, just thinking that at that point there was backwardation in that segment of the curve. I don't think that's going to stay in backwardation. I think by the time June gets here, we're going to be looking at contango again. So that's one trade that I see. The other one I'm kind of waiting for, and I'm lining up quite a few dominoes here, is I think that Trump is going to get tough with ISIS very quickly after entering office. And I wouldn't be surprised if there's some kind of ultimatum, ISIS, knock it off or else. And I think there's so much hysteria right now politically. There's so many people with such polarized viewpoints that you could easily see an overreaction, a massive upward spike in oil prices because a lot of paranoid people are convinced that Donald Trump is going to launch nuclear weapons on ISIS or something. I don't think that'll actually happen. If there was a $25 up spike in oil prices from here, I would look at that as a very, very ripe shorting opportunity because I don't think prices can go $25 higher and stay there because the shale revolution will be restarted, the Bakken will be relaunched, and those prices will come back down. So, I don't want to bet on the up spike. I'm not convinced it will happen. If it does happen, I'll definitely bet on the mean reversion. Frankly, that's all I can really see at this point for trades.
Yeah, to add on about oil's interesting to me because if you remember, I made a very public forecast on oil way back in 2015, I think it was, where I said, look, I think oil's going to fall to $30 a barrel. It was at like 110 at the time. And, luckily it got there. These things don't always work out that way, but it did. And the reason I had a lot of faith in that was twofold. One, the dollar was going up, and I thought it would go much higher, which obviously is the denominator of oil prices. So that helped that. The other thing was speculative position in crude oil was all-time highs. In fact, if I took the trend going back from the early 80s, it was 7 standard deviations above that trend, and well over 3 standard deviations, maybe 4 standard deviations from the trend in the last 20 years or 15 years. So the position was huge. If I look at it now again, I'm looking again on my Bloomberg screen as we speak, it's equal to where it was. So it came all the way back down, it's gone all the way back up. So the market is wildly, gigantically bullish on crude oil. And that is something that starts sniffing like an opportunity to me on the short side. I get what you're saying about the price risk, which is always the danger of shorting crude oil. It's almost a bit of a negative gamma trade, so it makes you a bit nervous. But I still think that crude oil comes lower, so I'm monitoring that. And I've seen a similar situation with copper, driven by China and a few other things, where copper positioning is wildly extreme. And so I start to think, well, too much reflation is priced into these things. Maybe there's some interesting opportunities on the short side.
Yeah, I very much agree with that. I want to be short equities here, and I want to be short crude oil. But I don't dare to touch either trade from the short side right now because there's been so much bullish hysteria in the equity market. I don't know what's going to happen. Sell the inauguration? Okay, I've said sell quite a few times in the last few years and been wrong. So, I want to be short, but emotionally I want to. I can't bring myself to do it because there's just been, every time I say, okay, the market can't possibly go higher than this, it ends up going higher. In the case of crude oil, I'm convinced that this rally is played out from a fundamental standpoint. It's that hysteria risk that if it happens, it's a fantastic opportunity to go short. I would consider puts on crude oil here, as a speculation that maybe they'll go lower, but I don't want to be in outright futures here. I'd rather be in puts on futures and, have a very limited downside if Trump scares everybody. And if that happens, I don't think it's a real risk. I just think it's hysteria. And look at, there's actually been an increase in residency applications in Chile because there are people freaking out about Donald Trump so much that they want to be in the southern hemisphere for when he starts the nuclear war. That's a fact. So,
wow.
This is hysteria, and until it settles down, I don't want to be on the short side of the oil trade unless it's in options or something, protected.
Yeah, I agree. What is interesting is oil volatility has been coming lower. Look, I don't think it's going to go back to where it was in 2014 when it was trading below 20, but it has come down from a peak of 80, but a kind of real trading range of 50 down to 30. If it comes any lower, the ability to buy options start to make sense because, oil volatility can go to 80, can go to 100. So maybe buying some puts on oil, or you buy kind of out of the money calls, out of the money puts if you've got the view that you have that there is a tail risk event of something that Trump administration will do to drive up the price of oil. I mean, that's possible. I mean, don't forget, that the economic policy is incredibly pro-oil in the US right now, or with the new administration. So it is in their economic interest to drive up the price of oil. So yes, I mean, I can see that too. So I love these kind of puzzles. These are the kind of ones that get me up at night thinking, wow, that's interesting. You've got all of the reasons why the oil price should fall, all of the geopolitical reasons and business reasons why the US wants a higher oil price. So how does this play out? What does that mean for us?
What do you think about junk bonds here? I've been short junk bonds for forever, it seems, and made a bunch of money on that trade, a long time ago. And now I've given back about a third of my profits, and I'm waiting for the big move, but it doesn't seem to be coming. What do you think here? Is maybe the end of the oil sell-off kind of spelled a stabilization of the junk bond market, or do you think that big credit risk a lot of people feared is still coming?
Right. So with the oil price going higher, it eases the worst creditors or the worst debtors, which were the oil industry. So that has been the relief rally in, let's say, the indices like the HYG. So we have had that relief. We've also seen an economy that started the year last year almost, I think it was negative in the first quarter with the ISM below 50. So it was very close to recession. That's when junk bonds become super interesting from the short side. When we've had this recovery, the oil prices rallied as well. Suddenly junk bonds aren't that interesting because shorting junk bonds is all about credit risk. Will credit risk explode when the economy is growing at 2.2%? Let's say no. Does it happen if the economy goes to negative 1%? Yeah, it completely explodes. It becomes a very, very lopsided risk reward. So they're really an economic trade. I think many of us thought the economy was going to be weaker last year. The election changed part of how that played out. And so it is what it is. The economy is growing whatever it is right now. I think the Atlanta Fed says 2.8. I think the market says 2.2. Let's assume it's somewhere around that. The question is where does it go going forward? Trump has no policies to put into place immediately to generate this growth that the market's expecting. How long could that take? I mean, as you pointed out at the beginning of the interview, we look at all of these elections, almost every single one of them has a recession immediately afterwards. And that's to do with the economics, the political cycle, and how it takes a long time to actually implement policy. So you get some policy paralysis, and the flip side of the goosing up of the economy going into an election. So to answer your question very long-windedly is, yeah, I'm also looking for the bearish side in junk bonds. It has to be about the weaker economy. If there's no weaker economy, there's no weaker trade. There's no trade to short it.
Yeah, I agree with you, and I've been waiting for it. And you and I keep saying this business cycle is just way long in the tooth. It's got to roll over. There's got to be a recession coming, and I still believe that. But it has not come as soon as we thought it would, has it?
I mean, Eric, this is the crazy thing, because people forget, right? We get basically, if we're looking at monthly data, we get 12 data points a year to look at how the economy is doing. Well, markets go, we have hundreds of data points over that period. If we're looking at daily charts, we've got 200 odd data points. So it always seems frustratingly slow to wait for these economic events, because we think of them like financial market events where things move relatively quickly. So we have to wait, for a trend to be established in the economy using monthly data. We're going to have to wait 3, 4, 5, 6 months for that to happen. So, maybe the economy is about to weaken, but we're not going to know for a while. So, it's a frustrating process. And people say, well, you were dead wrong. There was no recession last year. Well, we came bloody close. And fine, yes, I was wrong. There was no recession. But, we are still due that recession. It doesn't; those risks don't go away. The global economy and the US economy are cyclical. You do have cycles. You do have extended cycles like we had in the mid-90s. Maybe this time it's an extended cycle. It's possible. I don't think either of us are saying, well, it's not possible, that it's an extended cycle. It could be the longest ever economic cycle, but the probability is not on its side. So that's how I think about this.
Speaking of how you think about things, I want to tell you, first of all, I really love Real Vision publications. Ever since my subscription started, I've been getting all kinds of cool stuff, and it's fantastic. One of those is you wrote an 80-page report for your institutional global macro investor clients, and you've got that up on Real Vision publications. So first of all, please give us kind of an overview. I'd love to go into it in detail. Unfortunately, we're not going to have time in today's interview, but give us the executive summary of what people can expect to find in that 80-pager.
Well, that 80-pager is my January think piece, and I do this every January, that I free myself from worrying about what the markets are doing over the next month or 2 months, and sit back and say, okay, what are the really interesting things out there? What should we be thinking about for the next few years ahead? What is nobody else looking at? What is being really misunderstood? So in this particular one, I wrote an article about the advertising industry and the digital advertising business, just because I'd learned a tremendous amount. And that's had a huge feedback on that. People loved that article. And I guess it's because it was like a detective story of me figuring out how deeply flawed the advertising business is online, and how high-frequency trading creates bid-offer spreads of 75%, which is ludicrous. Then I covered, in fact, one of my clients from Global Macro Investor, Adam Rodman, wrote an article about Ireland and looking at Brexit and how Brexit may cause companies to leave London, but they want to remain within the European Union. So Ireland is the obvious place, which is English speaking. The only problem with Ireland is there's not enough property to house these people. So big headquarters like Google and Apple and people are all in Ireland. It's meant there's a tremendous shortage of property. So that means there's some huge opportunities. I also looked at Bitcoin and kind of updated my views on Bitcoin. I was very lucky last year to have captured a good part of that Bitcoin rally. And I've also been long in the kind of longer term part of the portfolio since Bitcoin was at about 200. So just kind of updating my views on that. I talk a bit about the Trump administration, and I generally avoid politics because I think politics and economics are two separate things. But, when you have an incumbent government, then everything's fair because you can criticize the government. I don't like getting involved in political debate ahead of elections and stuff because it's too heated and it's not necessarily what I do. But, I'm looking at the Trump administration, the similarities to potential similarities to Silvio Berlusconi in Italy, what that did to the Italian economy, what the opportunities here are now, what the narratives are. I look at some bombed out markets, which are one of my favorite things in the world, is you look for a market that's fallen 80, 70, 80, 90%. And if you look at the history of markets, no market stays down that way. They tend to rebound, and when they rebound 300, 400, 500, 600, 1,000%. So these are great long-term risk rewards. The ones that are on my radar screen massively are Greece and Cyprus. Cyprus fell more than any other market I've ever found in all history. And I said, any of your listeners know any other market that fell more than 99%, which is what Cyprus did. You've got to imagine that the opportunities in Cyprus going forwards over the next 10, 15 years have to produce decent returns. Greece is another one where you could have bought every single company in Greece for the price of Bed Bath & Beyond in the US. And I just think, well, that's nonsense. Bed Bath & Beyond is not a particularly good retailer either. And you can buy every single company in Greece. So I'm looking at those kind of things. I'm looking at the future of emerging markets and also the Internet of Things. So as you can see, I cover huge amounts of ground, all kind of a nice little dive into topics that people don't normally spend time over. We spend so long worrying about what the S&P is going to do over the next 2 weeks. But this is to step back and say, okay, let me learn something new. Let me think about things in a different way. So that's normally just for my clients, my global macro investor clients who, that's a highly restricted readership base. But I put it on Real Vision Publications because, obviously, Real Vision is my thing, but I also love what they're doing, the idea of the publications platform of giving people access to research they would never normally get. And the feedback's been fantastic. So people should just go to the realvisionpublications.com website. There's a free trial or a 30-day money-back guarantee. Just go in there and, you can check out research from myself, Pippa Malmgren, Stephanie Pomboy. They've all come out in the last 3 weeks. There's extraordinary stuff there. Stuff, again, people would never ordinarily be able to afford or get a chance to look at. So you can learn from all sorts of people. So it's really well worth doing. And, you get a 30-day free trial. I can't imagine anybody would want to keep one of their newsletter subscriptions to a newsletter writer who's not that well known, spams you with emails every day, and does all of those things that they do, versus getting research from 100 pieces of research from 30 of the smartest people in the entire world. I mean, the value proposition is ludicrous. It's about $300 a year, and for that, you get all of this.
I could not agree more, and I really want to endorse it myself. I have a subscription. I have been shocked by, I kind of thought, okay, look, you've got a lot of institutional writers here that charge $30,000, $40,000, $50,000 a year for a subscription to their work. All I'm going to get is going to be a paragraph or a teaser or something. It's not going to be real. And I have been shocked in the other direction. There is a lot of substantive content. As you say, Stephanie Pomboy's piece was outstanding, and you've got so much there. The thing I've noticed about too, which I never saw coming, I don't know if you guys saw this, I almost find it's a different mood. I watch Real Vision television, usually at the gym on my phone, on the treadmill, or it's a drive in the car thing, or it's a out and about. It's something I listen to in the background. Whereas in the office, for whatever reason, I don't really sit in the office all day and watch television, but I do read Real Vision publications. It's like a different mood that it satisfies. Maybe that's just me. But I really am impressed.
I agree. And also, all we're trying to do is create a world where people get access to excellence. Everybody does watch video. Everybody does read. It's about, we want people to get rid of the junk that they've been sold and get some proper quality from really experienced people who have proven track records, and listen to them and not to the stuff that gets sold to people because it's wrong. Finance is not entertainment. We take it very seriously. And so, we're seriously building out some really cool stuff.
My hat's off to you. I've been so impressed with everything that I've seen you guys do, which brings me to another subject. In this project that I'm doing here with MacroVoices, I feel very fortunate. I have enjoyed a monopoly, really. It's been almost a year that we've been doing MacroVoices, and of course, there's a zillion and one financial podcasts on the internet. But for this audience, for pro-finance and sophisticated retail investors, the same kind of audience that you address with Real Vision Television, really Real Vision Television is the only content that I even take seriously as competition for what I do, because for this audience, nobody does anything in the Real Vision Television is a totally different category. It's a paid service. But in the free podcast space, nobody's doing this. I'm the only guy. Until you decided to muck it up, didn't you?
I did not. You and I talked about this at length, actually, interesting enough, because we've been friends for a while. And we talked about, should we do something together here? What are the opportunities? And I think, we realized that we love what you do. It's got a really important place. You do a great job. Your guests love being on it. You've got a great audience. We want to do something slightly different and not disrupt your apple cart, because you've got your own apple cart and you're doing a brilliant job with it. What we're going to go and do is something wildly different. We're going to try and create the world's best financial podcast. And we're going to create an immersive world of multi-day broadcasting, incredible storytelling, and the kind of rich texture of financial life that people don't get, that they have to piece together from all around the world. We're going to bring all sorts of stuff. I won't really be able to give you too much of the details. We launch on February the 9th. It'll be called the Real Vision Podcast, and you'll be able to find it on iTunes, Stitcher, and all the usual places that you find them. But it's going to be a highly immersive financial podcast with incredible soundscape, amazing stories, a bit of fun, some great learning, and some interaction with the past, with some of the content that we've had on Real Vision Television as well. But it's not really about that. It's about creating a financial universe and letting people walk around in it. And obviously it's free of charge.
And I assume that we can now finally, because Aaron Chan has told our audience that it's top secret what he's working on for Real Vision. I assume he's involved in this project. What is his role? If this is something Aaron is producing, I know that our audience is going to like it.
Yeah, I mean, Aaron's involved in about 100 different things here at Real Vision, but he's been one of the key drivers with James Gibb in designing this. He also will be the producer of it, along with James. So he's been really instrumental in learning some of the great things that you've done. And again, because we didn't want to step on your toes, we wanted to create something very different. So, they've been hard at work doing that. And on February 9th, you'll hear the first iteration of it. And then it will develop dramatically over the next 6 months to be a really unique experience.
Well, that's fantastic. So mark your calendars, everybody, for February 9th. And by all means, have Aaron send us a link when you launch it. And we'll send it out in our Research Roundup email so that everybody has access to it. I can't thank you enough, Raoul, for another fantastic interview. We're going to have to leave it there in the interest of time. But Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
As our regular listeners know, our former producer and co-host, Aaron Chan, has moved on to begin a full-time career with Real Vision, and Aaron will definitely be missed. I'm delighted to announce, however, that Patrick Ceresna's company, BigPictureTrading.com, has agreed to sponsor MacroVoices by sharing the production costs with me. What I like most about this relationship is that Patrick shares my passion for delivering high-quality journalism free from advertising. So when I asked Patrick what he wanted out of this deal, I assumed he was going to ask for some kind of advertisement for his company to be included in the show. Quite to the contrary, Patrick explained that he'd rather just contribute useful content to the program. But I want to let Patrick tell you in his own words. So Patrick, explain please, why is it that you're willing to help fund this project without asking for advertising or any particular compensation?
Well, Erik, look, I'm in the business of teaching people how to be traders. We provide mentorship and analytics to help people capitalize on big picture opportunities. We have all sorts of classes teaching live and online, everything from fundamental macro analysis, technical analysis, options trading. So that's the business I'm in. Now, what I want to do as your new co-host is simply add value to MacroVoices in doing some of the teaching as a part of the show for free, without any advertising of any kind. The people who like me and like my style will find their way to my website and learn about the services we offer and the resources we have. And of course, I'd love to do business with them. With that said, I share your view that what makes MacroVoices unique is that it's not a sales pitch for anything. So I don't want advertising. I just want the opportunity to contribute some of my own views and ideas to the program. And we have to just figure out how my expertise can be of help.
Well, I can think of one possibility right now. After today's interview with Raoul, we've probably talked about this long gold, long dollar index pairs trade probably a dozen times now on the program. Quite frankly, I feel embarrassed because I don't think we've ever done justice to that subject. In order to put that trade on properly, you've got to do some homework and figure out a hedging ratio so you know how many DX contracts you want to be long for each GC contract that you're long, because obviously the gold is substantially more volatile than the dollars are. On top of that, I think a lot of our listeners can't trade futures in the first place. Even the professional portfolio managers in our audience, most of them are hedge fund guys who aren't registered as commodity pool operators with the CFTC, so they can only trade these things through ETFs, as a lot of our retail investors are limited to. And the hedging ratios are obviously different there because the contract size is totally different. Frankly, the reason that we've never gone into these details in the show before is that I haven't done the homework to sit down and do the detailed analysis. So I don't know if you guys get into that kind of thing at bigpicturetrading.com, but I would love to give our listeners more perspective on how to size that pairs trade.
We absolutely do. First off, there are several liquid ETF products available to position yourself on these types of macro trades, including the ability to use options to express the trade. We will talk about the options in a moment, but let's start off with the shares themselves. In this case, to consider a US dollar long against a long gold pairing trade, you can use the US dollar index ETF symbol UUP and the Spider Gold Trust ETF, the symbol GLD. The question, of course, is how do you size the trade? The US dollar index futures have 1,000 multiplier, making the exposure of each contract just over $100,000. With gold futures, each contract controls about 100 troy ounces, which makes the gold exposure about $120,000 per contract. So, in order to achieve a balanced notional value weighting, an investor simply needs to divide through and determine the number of shares that need to be bought to replicate the exposure. With the UUP currently trading just above $26 a share, you would need to buy about 4,000 shares to get $100,000 exposure. And in the case of gold with the GLD, with the shares closing close to around $115 a share, you would need to buy about 1,000 shares to replicate a futures contract.
Well, and we should be clear as well that those are unleveraged ETFs that you're recommending, which have a respectable record of tracking the actual price of the underlying asset, not to be confused with those double and triple levered ETFs, which usually have big tracking errors and issues with the term structure because of the way they roll the contracts. So what you're basically saying is the ratio is 4-to-1, but what you just described is an equal notional principal weighting, and I suppose that's a perfectly valid view. You could say that weighting the two legs of this trade based on balanced notional principal is the way to balance the hedging ratio. But frankly, that's a view that I don't share myself. It's not my view. I think about this trade in terms of volatility. So if you wanted to determine the hedging ratio according to a comparison of historic volatility between those two ETFs, what does that ratio look like?
Well, an investor that wants to go beyond that simple equal weight long dollar, long gold pairing can simply volatility adjust the sizing. As you have just alluded, without volatility adjusting, gold, which is the more volatile of the two, will play a far more influential role in determining the net profitability of your trade. The benefit of volatility adjusting is that it makes the two pairs more equally influential. In this case, gold has an implied volatility of around 14%, and the US dollar has an implied volatility around 9%. To adjust the GLD UUP sizing for volatility, one would need to consider owning almost 7 shares of the UUP for every 1 share of the GLD.
Okay, got it. So 7-to-1 ratio of UUP to GLD if you want a volatility balanced pairs trade. But with a ratio that's that high, the capital needed to hedge even a modest long GLD position, that's a lot of UUP shares. And that's going to be a pretty significant drain on your capital balance. Now, in the futures market, it's not important because the margin bond is tiny compared to the notional size of the trade. But in ETFs, it's a different story. So, Patrick, I know you're an options guy. Is there a better way to express the long UUP leg of this trade in terms of using, say, calls on UUP rather than outright shares?
Well, Eric, we would need more time than we have today to go in depth on the topic of options, but I will offer a simple options alternative. Simply by buying like a 3 to 6 month in-the-money call option on the UUP and alternatively as well as in the GLD if you wanted to, you could capture most of the upside with the high delta exposure. Now, the cash outlay would be similar to the margin required to maintain the futures contract, and the intrinsic value that you have on the in-the-money option helps reduce the impact of time decay and the need for short-term market timing. Now, while you must deal with paying a time premium, you have a big and often overlooked advantage in having a limited and defined risk exposure that does not have to be managed with a stop-loss order. This can often create favorable asymmetry in the outcome. We can explore this in upcoming podcasts in the future.
Okay. Well, thanks for that, Patrick. It's your first day, and you've already filled in a blank that we should have filled in the first time that we discussed this pairs trade on the show several months ago. So thanks for your help with that one. Before we wrap the show up, I want to very strongly encourage all of our listeners to take the time to watch Patrick's own 2017 market forecast video. It's free of charge, it's free of advertising, and it's a perfect way for you to both get to know Patrick as well as get to know his views on everything from the stock market to the U.S. dollar to crude oil. There's a link to the 30-minute video in this week's Research Roundup email, or you can just go to bigpicturetrading.com and look for the free 2017 market forecast video. What you can expect going forward, folks, is going to be a slight format change where you'll be hearing both my own views as well as Patrick's. Sometimes we'll agree, sometimes we'll disagree. So, Patrick, welcome aboard as our new co-host.
Well, thanks, Eric. I'm so glad to be here, and I'm really looking forward to contributing to this program. Anything else you want to add before I try my very first show wrap-up?
Well, folks, please let us know what you think. We are changing the format a little bit. What I'm thinking here is we take the content of our feature interview, look for something that needs further examination. In this case, it was the pairs trade that Raoul Pal and I have talked about, and we'd never discussed how to size those positions. So I'm trying to leverage Patrick's experience as a trading educator and sort of bring a little bit of perspective on that. And what we're thinking about doing going forward is just looking for something in each feature interview where I can lean on some of Patrick's perspective and get some insight on how to actually put these trades on. Is that what you want? You want something else? Let us know, because this is a listener-driven program. We're going to take your comments into consideration. Again, Patrick's business is online trader education, so anybody who's interested in what Patrick's company has to offer should definitely check out bigpicturetrading.com. Meanwhile, we need your help promoting MacroVoices. We've got some really fantastic, high-profile guests coming up in the next few weeks. I think you're going to be really happy with where the show is headed. And, you know, the way we get them is because of the number of registered users we have. So please, if you haven't already, go to macrovoices.com, register your free account. Only takes a few minutes. The benefit of it to you, of course, is you'll receive our Research Roundup email, which is a compendium of links to all the best, cool, free stuff that we could find on the internet each week. So please sign up. Please help us by retweeting, telling all your friends about Macro Voices. You'll get the Research Roundup. Patrick, what are we going to have in this week's Research Roundup?
This week, we're starting with something new by providing the written transcript of the interview between Erik and Raoul. The link for will be in the Research Roundup email, but it won't be active for another 24 to 48 hours, so patience with us on that. Now, we have a short video by Raoul Pal where he shares his insights on how he invests. We also have that link that Eric mentioned earlier for the 2017 market forecast video. Further to that, we have a PDF from Bruce Levy sharing his technical observations. In the research library links, We have the CNBC article with the comments from Ben Bernanke suggesting that Trump's views on China's yuan don't fit with reality. We also have a look at Jeffrey Gundlach's forecast for 2017 and a video from Mark Faber discussing his views on precious metals. We'll find that and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make the program even better. For those of our listeners that write or blog about the markets and would like to share their content with our listeners, please send us an email at researchroundup@macrovoices.com or tag it with MVRR hashtag on Twitter, and we will include it in our weekly distributions. If you haven't already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.